Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Tuesday, August 5th, 2025. The US dollar gold price is just under $3,400. The narrative going around with the US government economic data, and there was a snafu, a kerfuffle on Friday. The jobs reports came out as bad. President Trump already was very, very angry, more angrier than usual, perhaps. And I guess he's trying to pin the blame on the head of the Bureau of Labor Statistics. Today's special guest is a returning guest. He's been covering this stuff. He's been covering the real government numbers, shadow government statistics for decades now. He uses the old formulas for jobs reports, unemployment, CPI, consumer price index, GDP. John Williams of Shadow Stats, thank you for joining me again.
Thank you for having me, Jason.
So, John, there was a huge controversy on Friday with the jobs report numbers. President Trump was angrier than usual, as I said in the intro. Do you think that this was worse than normal, or do you think that this has been an ongoing trend for a long time?
Well, the numbers involve the payroll employment. The problem is that how the government counts the payrolls has been fairly well set over time, but and it's been heavily manipulated over time. And there are periods of time where you see some catch up. I've been looking at these numbers again, as you mentioned, for decades. And back in the days, I think the Bureau of Labor Statistics now is out somewhere in Maryland, but back in the days when the Bureau of Labor Statistics was in Washington, D.C., and you could just walk into the office and go over to the desk of the guy that's putting together, or the gal, putting together the unemployment numbers. You could sit down and talk to them, and I did that again. This is when they were still back in Washington a couple of decades ago. And the question I had, very simply, is that when you look at the annual benchmark revisions to the payroll employment, you have to keep in mind the Bureau of Labor Statistics estimates and surveys the level of people on payrolls every month, and then those numbers tend to get revised, and then at the end of the year they have a benchmark revision to try and catch up and improve the quality of the numbers. And those numbers usually get published in January of the next year. What I found after 5 or 6, probably 10 years looking at it, is that every January the headline labor numbers revised higher. Looking at the annual benchmark revisions to the payroll numbers, which happen every year, they have an annual benchmark revision in January that goes back and restates all the prior history. And the what happens is the numbers come out each month, and they're reasonably strong or whatever. And then at the end of the year, they have an annual benchmark revision. And the way it used to be was at the end of the year, they would revise the numbers lower every year. And I went in one time and just talked with the fellow that handled the numbers, and I said, "Why do you do that?" And he said, "Well, if I don't do that, I'll get fired." And I said, "Why is that?" And he said, "Well, if if I understated the employment numbers, that would be a horrendous problem. I'd get fired. So I have to overstate them, and then at the end of the year, we adjust them with a downward revision to where they should be." And nobody really paid too much attention to the benchmark revisions, but they always had to have the positive numbers. And if they didn't do that, this fellow would have been fired. That's the way he put it to me. So I will not be fired. And that's similar in scope, and probably still a modern evolution of whatever happened, or whatever happened this last week was a modern evolution of that same process.
Yeah,
Um,
they're blaming for our listeners out there not familiar what they're blaming it. They're saying it's political. They're saying that the person at the Bureau of Labor Statistics was a Biden administration appointee. So it's kind of they're using the political football and they're saying, oh, we're going to replace it. But I sent you there was a new revision. It came out from I think a hedge fund, and they were looking through the data last week, and I think the Bureau of Labor Statistics didn't they just announce that like 30% of the data that they're collecting now, it used to be only about 10%, but now 30% of the data are all assumptions from formulas or models. So they're not actually even trying to collect the data. I think that's what was because of the government employee firings. I think that's a new revelation that's come out.
yeah, that's I don't remember seeing that, but I'll it makes sense. That's they're certainly moving in that direction. It's very difficult to track all these numbers, and if you have something that's politically expedient, that'll tend to get by in the given month, and then at the end of the year, they do have benchmark revisions where they do have some hard data and try to come up with something that's a little more meaningful. Um, you'll see that with the GDP and the employment numbers. You can even have that occasionally with the inflation data.
Now, I
Um,
want to I want to ask you about the official unemployment rate versus the U6 number, which our listeners might not be familiar about, versus the other numbers that you track for unemployment, because you track a larger, more wide spectrum unemployment number that the government has basically just stopped counting because it doesn't look good on the headlines for the stock market.
well, they have formally six levels of unemployment that they publish. Each one is the lower the number. Let's say U1. That's people unemployed 15 weeks or longer as a percent of the civilian labor force. Then they go up to U2, job losers and people who completed temporary jobs as a percent of the civilian labor force, and up to top. The headline U3, that's the one that's widely followed, is defined as a total employed as a percent. Excuse me, total unemployed as a percent of the civilian labor force. That's the official unemployment rate. And then they go up to they go up through level excuse me, U6, which is the total unemployed plus all persons marginally attached to the labor force plus total employed part time for economic reasons as a percent of the civilian labor force. Those who are marginally attached to the labor force are those who are classified as discouraged workers, um, people who have been looking for a job. To be counted as unemployed, you have to be looking for a job, and but they haven't been able to find it for a long time, so they've given up looking for a job. And the what you'll see here is that the when you had the standard reporting, and we'll see what happens with the current circumstance, uh, month after month after month, where they were just reporting basically their guesstimates from on the monthly numbers. You'd get numbers that tend to be excuse me, understated a little bit in terms of unemployment is a reasonably happy number, and then at year end, you'd see a number that was a weaker number, higher number of unemployed, and that's when they'd put out the benchmark revision that had all the actual numbers, but that the revisions generally were not announced heavily. They didn't have as much political implication as the month to month. What you just saw here with the firing was a month to month, which is unusual, and that was tied to the payroll employment. Um, that there's something funny that went on there. Normally, that would not have happened. What they're doing there until January, their January benchmark revisions. So we'll see what comes out on that in terms of the full story. But traditionally, they'll they'll understate, excuse me, they'll overstate the payrolls, or they'll overstate the payroll growth on a monthly basis, and then they'll revise it downward in the annual benchmark revision that nobody pays too much attention to. So that's how they handled it. Now they're showing weaker numbers, and someone got fired. There's a lot more coming out on that than has been published. Something funny's going on in the reporting.
Yeah, I agree. And we're also starting to see this like anecdotally with the earnings reports from a lot of the technology companies. I mean, Microsoft, I think in the last 6 months, give or take, maybe even a shorter time frame than that, they fired 22,000 high-level computer programmers that were earning 6 or 7 figure salaries. So even though that Microsoft has enormous profits right now, they're firing. I don't know if the jobs reports are covering any of those, but I do speak to HR people. There's someone I'm trying to get on for an interview, and she's just basically talking that there's tons of like fake jobs posted now, and a lot of these 6 figure jobs are on the chopping block, especially computer programmers, but also stuff like paralegals. It looks like artificial intelligence software is going to be a net job destroyer, at least in the short term.
I can believe that.
So you think then that basically with the type of spin that's going on, the narrative that the reality then for the jobs numbers, it isn't going to reflect that people, let's say if a computer programmer that was making $500,000 at Microsoft, if he has to go get a $80,000 job, that's a huge pay cut. If he still he or she manages to find a job in a couple of months at a lot lower salary, how is that going to affect the unemployment and the jobs numbers?
Well, if they can't find a job, as long as they can't find a job and they're looking, they'll be counted as unemployed. If they give up looking for work, they can be, because there are no jobs here, they'd be counted as a discouraged worker, which moves them from the headline U3 into the broader U3 elements until they're no longer counted as discouraged workers. Um, but they would be counted as unemployed. If they just give up looking for work, they won't be counted as unemployed, because you have to be counted as unemployed. You not only you're not only do not have a job, you're not actively looking for work. If you're actively looking for work, they'll count you as unemployed.
Now you said that you have unemployment. This is counting people that have stopped looking for work, and the government used to count these numbers decades ago, what, in the 80s or 1990s. You said that that number has hit 27%.
Well, yeah. In other words, you have there are different ways that things are counted. Um, if you look at and the government has 6 levels of unemployment that they report. The headline unemployment rate 3 is the headline number, and in July that was at 2.0%. Their broadest measure is called U6, and that was at 7.9%. And the difference is there that at the U6, it's everyone who's unemployed plus people marginally attached to the labor force, plus total employed part-time for economic reasons as a percent of the civilian labor force. So the part-time, the part-time um, and the marginally attached are ones who are not fully employed but want to be fully employed, and they're taking other jobs, so they're not fully employed. It's not a they're not fully employed. They're being counted in the broadest unemployment measure, which went from 7.7 in June up to 7.9%, and that's where the headline U3 went from 4.1 to 4.2. My measure, and what I do is I base mine on what the government publishes, but where they have, if you're a discouraged worker, you've given up looking for work because you feel there are no jobs to be had. You're counted for a while, but then they don't count you. And if my viewpoint is, if someone's a discouraged worker, they want to work, but they can't find a work, then there are no jobs to be had where they are. That they still should be counted as unemployed, and as opposed to just being cut off after 6 months, which I think that's the cutoff point. If you're discouraged for 6 months, they no longer count you. And if you look at that with the employment spectrum and the labor force spectrum, Right now, I'm up at 27.8% unemployed. That and the difference there between the government's broadest measure, which is right now at 7.9%. The difference there is are discouraged workers who would like to work, but they can't. There's no work to be had where they are. It's a big problem we have in the country, and but they're not counted because they haven't actively looked for work recently. And the reason they haven't looked for work is there are no jobs to be had, but the government doesn't count that after a certain point in time.
Yeah, I think any jobs that would be available would be a lot lower paying if you're a computer programmer at Microsoft. And the person I'm referring to, her name's Amanda Goodall. She's at the Job Chick on X. She covers a lot. She has an enormous network of intelligence gathering for HR professionals, employees. They send her screenshots, emails anonymously, and it looks like Microsoft is doing insanely large, many, many thousands of mass firings that are not being counted right now. So these are people that were earning hundreds of thousands of dollars a year, and either they were just given like a text message or an email at 3 a.m. that they were fired in the last couple of weeks, or they're about to be fired because their coworkers were all
Yeah.
fired. And it's all due to automation, John. The other data that's coming out that came out in the last week or so, it's showing that a man age, a young adult male age, 25, I think, to 40, that has a college degree, they have the same unemployment rate now, I think, in the US as a adult male in the same age demographic without any degrees at all. So it's starting to look pretty bad out there for men in
Yeah.
unemployment.
It is a difficult circumstance.
So now I want to move on to GDP. I want to ask you about like the government collecting tariffs and tax receipts. Does the government count that if the government is collecting massive tariff revenue? Is that kind of like positively towards GDP? How do you think they're going to try to spin this with the tariff collection? Because I think it's hurting. I would say the tariffs are hurting small business and like the corporations are getting exemptions.
Yeah, well, it's all mathematical. The government's collecting an income tariff that would probably be counted in the GDP, but the what's not being counted is the impact radically reflected is the impact on the domestic economy. You have the foreign competition has been a major factor, and there are a number of funny things that are done with those numbers. The problems with the GDP are not so much with the imports and the exports, although that was a factor at the beginning of this year, for the first couple of quarters, where Trump started to impose tariffs and such. You had a flood of imports from companies trying to get their goods into the country under the tariff before the tariffs hit, and after there's been a lot of disruption with that. The problem is that we have an underlying economy that is not as strong as advertised. The Right now, I have my just dropped my pen there. Um, it's still they're reporting it in the it's still in the 3 to 3.5% range where they can, but the games that are being played with the exports and net exports and such do affect that. If I said they don't, they do, because you have in terms of the domestic economy, imports are counted as a negative to the GDP growth, and exports are counted as a positive. And so that we're in the first quarter, you had a small negative GDP growth. That was due to the foreign manufacturers trying to get their goods into the country before the tariffs hit. So we had a big surge in imports. That's dropped off. I don't think we're seeing much of a surge in exports, but that's that was the difference between the second quarter and the first quarter estimate and the initial second quarter estimate, which
Well,
was
isn't part of the tariffs one of the goals, at least, is to protect the domestic industries like automobile manufacturing, some of the others, so there isn't net even larger net job losses?
yes. I mean, the tariffs are designed to minimize imports and to maximize domestic production of those related goods. Sometimes you'll see the same thing with other countries. It's a way of trying to encourage your own economy. Um, but that has distorted the headline GDP. I mean, the first quarter was a small contraction, and that was due solely to the surge in exports to the United States from foreign exporters, um, domestic importers trying to get around what the Trump regulations were doing, so that you had a big surge in the imports, and that took the net exports more negative than they would have been otherwise, and that actually pulled the small GDP, the what would have been a small GDP growth down to it pulled it down to small contraction. We had something of a growth in the third quarter. It's not strong. There are serious problems with the GDP numbers have been all along, and I offer as evidence of that. I mean, let me back off. There are games that are played with the inflation numbers. Um, if you're looking to the GDP, if you have high inflation, that tends to knock down the real growth, which is the way the GDP gets reported, and we're seeing much higher inflation than's actually being reported. So the numbers are not quite as good as uh, are being promised. Um,
Okay, that's an important point that you brought up for our listeners out there. Now, the GDP, does that even use the consumer price index to account for that? So, or is it using like a deflator and it's using for inflation assumptions, it's using less than the CPI?
well, the CPI is for domestic inflation and on domestic goods, and there is in theory, some relationship there between that and the deflator. I mean, the deflator is nothing more than the inflation weighted for the imported goods and the exported goods. I mean, it's a trade balance effectively on inflation, uh, and that'll vary. It's something that can get that can get played with. The problem is that we have the GDP is probably the worst quality series around. It's so heavily guesstimated and played with politically. Um, where I would offer some evidence on that is that if your aggregate economy is growing, which it's now doing, as reported, that should also be true of the underlying economic components of the GDP. And if you look at the domestic economy, um, and you look at let's say retail sales adjusted for inflation. I'm looking at these now uh, at this is at the first and second quarter. Um, the adjusted for inflation, the year-over-year change has been flat to negative. Industrial production has been negative. The housing sector has been negative. These are all year over year, and yet the GDP is up 3.5% as reported in the same period, and that's a pretty good trick. I mean, you get the major components of your economy are flat to minus. The GDP's um, average or above average year over year. That's nonsense. It's the GDP is so separately calculated. It's difficult to tie to those subsidiary numbers. Has been for a long time. Um, I look at it pretty much as a promotional gimmick for the whatever administration is in place.
And there also
And
seems to have been a 182 by the Trump administration because within the first once he had his inauguration ended January, February, March, he was saying he didn't care about the stock market. They're focused on cutting $1 trillion of government spending with Doge. And then here we are now, the Trump administration, they promote Bitcoin and the stock market nonstop. They're pumping the stock market as much as they
yeah,
can. And they didn't cut $1 trillion in spending. It's actually like, yes, they did cut some and they did highlight a lot of the government fraud, waste, fraud, corruption, and abuse with Doge, but they actually didn't cut spending, John. I mean, the budget deficits, like they're blowing out, right? Because to get the Trump tax cuts passed in the big, beautiful bill, they had to trade a
yeah,
bunch of votes and they had to spend an enormous amount of money to get the votes.
right. No, the deficit's not about to go away, and we've had a lot of funny things with the numbers in the last year or so. With and even go back to the onset of the pandemic. Um, if you look at the what happened with the pandemic, it hit in March of 2000. Um, Economy was clobbered. Uh, we had surging inflation. They cost Trump his, his reelection. And the one thing that you'll find a good indicator here of how the economy is doing is whether or not you see a change in administration with the presidential elections. Because you can play all sorts of games, and people will parrot back what they hear from the government. But when it comes to voting their pocketbooks, such as in a presidential election, they know how they're doing, and if they're doing well, they'll tend to support the incumbent, and if they're not, they'll tend to oppose the incumbent, vote for the opposition. And that was, if you believe the GDP numbers that were coming out of the Biden administration, even though there's a shift in candidate there, it's the party that usually gains the support. Um, the Democrats should have won, and they didn't. The Republicans did, and that was a pretty good indicator that the economy is not as strong as advertised, and indeed that we're heading into or in a recession. And now that recession is beginning to show in the numbers. Trump's exaggerated it with all of his unusual policies, and well, it'll be interesting to see how this works out. But I would contend that you're going to see a headline recession over this next year. It is presumably things will stabilize and you'll be coming back the year after. But it's there's still some difficult uh, times ahead. It's not a we're going to have higher inflation. Um, you look at the headline CPI right now, up 2.7%. That was in June. Um, the If you look at the way the inflation used to be calculated, same basis, the way it used to be calculated, say back in 1980, when it was honestly prepared, that 2.7% would be more like 10.7% today. And here's where you're going to see that see where that will work out and where it's already working out. What I have done, and anyone who's interested, they drop me a line at John Williams at shadowstats.com. I'll be happy to send them a copy of this. I can show you a plot of the headline CPI as it's been. The alternate CPI, what I call the shadow stats alternate CPI. So it's the way the CPI used to be calculated before they started playing games back in 1981. Up through 1981, the CPI was reported on a consistent basis. At that point in time, there's a bigger than expected pickup in inflation. It cut into the deficit spending that the Congress wanted to do, and the Congress worked worked to redefine the consumer price index. In fact, Catherine Abraham, who's was the head of the Bureau of Labor Statistics that publishes the CPI, had in her memoirs that Newt Gingrich said, "Hey, if you can find a way to report the CPI this way, we may be able to find more money for the Bureau of Labor Statistics." Well, the Bureau of Labor Statistics did, and the Congress did. And starting, the first changes were in 1982. The first thing they changed, and keep in mind that the series up to this point in time has been reported on a consistent basis. One of the big components in the CPI was the cost of housing. And rather than have a component for the cost of owning a home, the Bureau of Labor Statistics replaced that with the concept of homeowners equivalent rent, which is where the government redefined what the average person would pay himself to rent his house to himself. And the effect of that one change knocked 1.5 percentage point off the aggregate CPI. The total CPI was reduced by 1.5% based on that one gimmick, which I think was unconscionable, but that was only the beginning. And what they did was, then here's all been published by the Bureau of Labor Statistics. They still talk about it, but just recently they've stopped publishing the impact. I recorded what they reported as the impact on CPI, and every time they made a change, every single one had the effect of reducing the headline CPI. They'll still tell you what changes they made, but they don't tell you what it did to the CPI anymore. But with all the changes they have made over time, you end up now with a differential between where the CPI would have been had they never started playing games with it, and where it is now reported of order of magnitude 8 percentage points. So that if you look at the June CPI, which year over year was reported at 2.67%, that would have been 10.7% on the old basis, the way the way the CPI had been consistently defined up through 1980. And if anyone's looking at generally accepted accounting principles, the concept there is that you use consistent numbers. You don't start playing games with them. I mean, this you talk about cooking the books. This is a big case of cooking the books. So what I did, I used the government's estimates as to how much they knock off the CPI, and I added it back in. And I started reporting the CPI based on the government's numbers, just adding back in what they said they took out. So that and that's where it stands now. It was 10.7% against 2.7%, 2.67 in June, and that's using the numbers they've published. That's a significant difference. I mean, you're on Social Security, instead of getting a change of order of magnitude 2.7% increase next year, you have an increase of 10.7%. That makes a big difference.
And the narrative, John, that's repeated on like Business TV and Fox News is that because oil prices and gasoline prices are relatively low, the tariffs haven't caused inflation. They just keep repeating this ad nauseum many times per day that inflation's not a problem anymore.
Well, the thing that they've redefined it. In other words, instead of you take that housing example, instead of using uh, using the cost of a home, of having a home. They redefined it as homeowners equivalent rent, which is nonsense. I mean, there was no concept like that before, and it would, again, in terms of the way they used to calculate it. If you're owning your home, you pay taxes, you have electricity, whatever it is. Um, forget the old standard. Using their new numbers, that reduced not just the housing cost, but the total aggregate consumer price index, which has the housing cost as a component. The CPI was lowered by 1.5 percentage point in the year that they made that change. It's a tremendous change, and that's it's not getting any better. So what I'm looking at here, um, is people say, well, that's I can't believe that. That's just too large. I did something recently which surprised me. I'm not really too surprised, but I didn't expect it to come out as it did. And that is that I published the headline consumer price index uh, against my alternate consumer price index, which has the same number in 1981 and 1982. They start to separate, and against uh, the price of gold. And what I found is that gold and the headline CPI, the government's number, they sort of move in tandem. And they say when they move in tandem it's on the same graph. Back, I think it was 1970. Um, both the headline CPI and the price of gold, I think they were both 70 that year. So that you had an equivalent point. So just using that and going forward, um, the headline inflation and the CPI track well until you start seeing what happens in the early 1980s, and then it starts to diverge. And the gold price starts rising in the graph where against the headline CPI. But if you put in my CPI estimate, which is the way the CPI used to be reported, and presumably reasonably close to where it would be reported today if they hadn't made all these changes, moves higher with gold, and remarkably so. I mean, you have to see it to believe it, but I'm happy to provide this and provide anyone who would like to see the data. Just send me an email, johnwilliams@shadowstats.com, or give me a call at 707-763-5786. 707-763-5786.
I want to ask you about financial history for the U.S. government, budget deficits in other countries for budget deficits. So if these things keep expanding, the size of national debt is growing, the interest payments on the debt, are these things normally inflationary in past financial history?
Sure. Yep.
So the deflation argument, what there was deflation, what during the Great Depression 1929, it was for 4 years, from October 1929 to about 1934, and then FDR and his other policy advisors started to do massive budget deficit spending. They devalued the dollar against gold, they revalued the gold price. So there was pure deflation, what, for 4 years, but other than that in U.S. history, there wasn't a lot of examples of pure deflation where the government, the politicians, the bureaucrats, the Federal Reserve Bank didn't try to intervene and basically create massive inflation.
I haven't. I have not done specifics on that period of time of the numbers. They were gathered and they're not. Some of those numbers are retroactively estimated. I will take a look at it, but what they did in the response to the Great Depression is nothing parallel to what happened here. This was just back in those days. They still believed in trying to balance your budget. It's only when you get into the early '80s that the concept of having any kind of a balanced fiscal condition it just goes the way of happy politics.
And it also looks like the U.S. Treasury has started to do a massive amount of what fiscal dominance or financial repression. I'm not quite sure if it's full debt monetization, but it's starting to look very sketchy in the last week or so, where they doubled, I think, the amount of U.S. Treasury bond buybacks that the U.S. Treasury is doing.
Well, it's anything that has the effect of increasing the money supply will tend to be inflationary. That could actually contract if they're buying back, they're taking currency out of circulation. So that actually could have something of a tapering effect on inflation, at least on the money supply.
The money supply is not contracting, is it though? I mean, isn't the money supply starting to grow? The commercial banks, the private banks, aren't
Oh yeah,
they?
no, the money supply is growing. What I'm saying is that in the if the government's borrowing a lot of money uh, to fund its deficit, that'll increase the money supply. But if they're looking to pull back and on the liquidity, that would tend to go the other way.
Yeah, I think the private banks, they're for fractional reserve banking, they're not actually lending a lot into the real economy, John. I think
Yeah.
they're buying U.S. Treasuries. So I think the money supply is growing, but I think they're buying Treasuries. They're not lending.
Okay.
They're not giving out consumer loans. They're not giving out business loans.
Well, the Treasury, yeah, if you're looking at the funding of the federal debt, and that is explosive. That is indeed inflationary. I mean, you're running it. Your deficit is far from under control. It's still getting worse, and those that extra money that is pumped into the system is indeed inflationary. I mean, there are two elements that are driving what at the moment are really a really bad inflation problem, and it's worse than reported. One is the money supply growth, and the other is the funding of the federal spending. Um, it is that they both the federal spending is a big contributor here as well, and I will show if you look at the total debt, and again that's the money that it's borrowed. That's been growing as badly as rapidly almost as the deficit, and that tends to be inflationary. Yes.
So the consumer price index right now, it's saying the headline inflation number, it's below 3%. They're claiming it's headed to 2% because a lot of it is because of low gasoline prices, low oil prices. But your real inflation rate is substantially higher than that. I think we've had these conversations a lot over the last couple of years. You
Yeah.
said that inflation peaked out in 2022, mid to late 2022, early 2023. It got to over 18%.
Uh, yeah. That's it is the headline CPI is off its peak with the pandemic, but at the same time you still have uh, the ongoing games that are being played in the reporting there, which uh, still it has it well, it has it so much above I mean, right now that say or June was 2.67 in the CPI. My estimate was 10.7%. Where the in May it was 235 on the headline CPI, and my estimate was 10.5. It's there's a very large differential there, and depending upon the games that they're playing, the differential tends to increase. The differential is holding reasonably close at the moment, but it's up around to over 10%, 10 percentage points. So I'm sorry, that's not the differential. That's the shadow stats estimate. The differential is about 8 percentage points. So it's 8 percentage points on top of the let's say the June was 2.67%. That was a headline CPI. The shadow stats would be up at roughly 10.7. So
It's definitely stagflation. So you said 10.7 is the real inflation rate according to your numbers then?
that's if had they reported inflation, if they kept reporting the inflation the way they were doing it in 1980. And keep in mind that the people who took on the Social Security retirement package at that time were promised that they would get that it'd be adjusted for the consumer price index. But no one was expecting that they would restate the way they calculated the consumer price index. So if you've been on retirement for 40 years, which is a pretty long time, I mean that would be an extreme. Um, you're what you're receiving right now is 8 percentage points adjustment shortage against what you would have had before. If you retired in 1970, the differential would be less than that. But the differentials are significant over time. And again, if you look at the way the CPI being reported today moves with gold against the way the CPI with the shadow stats adjustment moves with gold. Gold is effectively a direct measure of inflation. It's your best hedge. Uh, and again, I knew that gold held that function. I just didn't know that it would follow the gimmicked the adjusted gimmick numbers so that you had the way the CPI would have been, should be, still is on the old basis. The gold is following, is reflecting that the shadow stats number, not the headline CPI.
Well, yeah, I think the gold price has been averaging. I think now that the price has had a huge rally the last like 14 months, I think the gold price is averaging about 10% annual compound average annual returns COGR. So I just saw someone update that at this around 10% annual return. So that would hit the numbers that you just said. And I think that it's really, really simple, John. The last three plus years, because of the policies out of DC, the budget deficits, the problems in Congress, the problems in the White House, both political parties with spending, and then you add in the sanctions, whether that's the Russia sanctions 3 years ago in February 2022, or these tariffs that Trump is threatening that he raises sky high and then he wants them down, but they don't come down right away, or he delays them. It's the average other country that's outside of the G7, so non-G7, the BRICS countries, they do not want to buy treasury bonds. They are buying gold. So they see maybe they're subscribers to you. Maybe these central bankers in the non-G7, John, the BRICS, are subscribers to your newsletter at Shadow Government Statistics, and they see the real inflation rate, and they are accumulating gold each month. They are buying a lot of tonnage.
Well, believe me, the BRICS know what's going on.
I mean, you basically have to be a brainwashed political hack in DC to not acknowledge reality.
Well, it's terrible, but the way Washington is looking at it is they just have to keep selling this to the people who are on Social Security that they're getting a full package. That was the whole purpose of the what they did to the numbers in 1980. And it's I do a documentation, but the documentation I have in that is from the memoirs of Catherine Abraham, who was the head of the Bureau of Labor Statistics at that time, and her conversations with Newt Gingrich, who was working on the budget deficit.
Is that an old book? So is that book from like the 1980s or 1990s?
Maybe I'll send you a copy of it, and you can see where else you can find it.
Oh, so someone should scan that in. They can digitize that now. If it's a really old book, I saw that they're working on scanning and digitizing that in to make audiobooks, so there's a record of it. So hopefully, if it is an old book, someone's going to get around to making it an audiobook and digitizing it and putting it online, because that's some really interesting stuff there that basically, like, for decades now, since the 1990s, you said that Congress and the White House have been trying to get these numbers changed to benefit them, for GDP, for jobs reports, and for inflation.
Yes, and so it was in the early 1980s. Well, let me put it this way: the estimates on the differential are available. Used to be available from the Bureau of Labor Statistics. I didn't make up the numbers, because what they did was they published. They used to have what was the basis here used to be known as the Consumer Price Index. CPIU, all urban consumers. And that's what was the basic CPI. That's what Social Security was based on. And it's the CPIU that was redefined over time. And and it was done by the Bureau of Labor Statistics. But what the Bureau of Labor Statistics did in recent years, and you can find it on the site, at least some of it, is they started publishing the CPIURS research series, saying, my goodness, we found so many ways of improving the consumer price index. Suppose we had put this in effect back in 1970. How much better off would we be today now in terms of the headline inflation numbers and what would have been paid out on Social Security and such? I kid you not. They published the CPI U-RS series. And they published a list of all the changes that were made to the CPI, and the factors that were being changed, and the difference between the CPI before the change and the CPI after the change. And in every case, it reduced the headline CPI. So what I did was, and what I've done, what my series effectively represents, is that I went back and reverse engineered the research series, putting the old CPI back in instead of the new CPI. And where my CPI numbers began to, I guess, attract some attention in Washington, I think it was after 3 or 4 years, I got a call from the Bureau of Labor Statistics. They said, we understand you're publishing an estimate of the CPI. And I said, yes. And he said, well, what are you doing? I said, well, I'm reverse engineering your research series. Oh, they hung up the phone. Never heard further from them. I kid you not. And now, again, what I'm doing has been gaining more attention in recent years. Now they still publish the research series, but they've taken down all the numbers there that show the value of the change that each series contributed to reducing the CPI. That's no longer there. That just disappeared this last year.
Well, it's drifted further and further away from reality, John. So you've done an excellent job. I mean, like, you showing the real inflation rate or close to it. I think the real inflation rate might have even been higher than the 18% or 19% that you had in 2022. I mean, I was listening to an interview with hedge fund manager Kyle Bass, and he was talking about how the money supply had grown by about 50% in 3 years, from like
Yep.
2020 to 2023. And then he said that
Yep.
other countries were also growing their money supplies by more than 50%. So he said the
Yep.
50% number in only 3 years was the U.S.'s money supply growth.
Well, what I will do, um, and again, if your listeners are interested, I'll be happy to send this to them as well. I'll send you a copy of the graph that shows the price of gold as published against the headline consumer price index and the implied old consumer price index based on the CPI's estimates. And what you'll find is that gold overlapped. I can take it back to 1665, what you've done. Gold and the CPI tend to move together. And it started, they started breaking in 1965. Um, there were some things that other distortions with gold. The numbers with between the ongoing consumer price index and the newly defined consumer price index and the old consumer price index, that was in 1982, and that's where you start to see a big split. But that big split very quickly catches up with the gold. There's a little bit of volatility in the gold, and then the gold is just tracking the old CPI series, just one-on-one basis. Uh, I take that as confirmation of my estimation of it. It is the numbers all the time. I can send the details to anyone who's interested. But more than anything else, I think that will show you where the reality and inflation is, and
And
it's not good for people living on the cost of living adjustment for Social Security.
it's not good for anyone, John, unless you own a lot of Bitcoin, a lot of gold, and a lot of exposure to what the Mag 7 and the S&P 500. So those are the asset classes that have been rallying a lot with all this inflation that you're suggesting, all this extra liquidity is ending up in these key asset classes, whether it's Bitcoin, gold, or the Mag 7, the S&P 500. Really, it's only, I think, seven stocks, the Mag 7, that have the majority of the gains in the S&P 500 anyway at this point.
Yeah.
It's absolutely out of hand. But from what you described, John, it sounds like the best case scenario, and we're talking like if Trump and Congress nail the landing, the best case scenario is where stagflation. I mean, things could be a lot worse than that.
Well, no, I think we're going to have, well, in terms of what the headline, that may be the case. And then you can add 8 percentage points on top of that, and it maybe he's not so happy.
Oh boy, that's not really stuff I want to. I mean, I own Bitcoin and I own gold. I own silver. I have a gold royalty company shares. I have some other energy exposure and stuff like that. Other inflation hedges, but like the average person doesn't have all these things. It's not looking good out there right now.
Yeah. Well, personally, the area I look for hedging is gold. It's been a traditional hedge against inflation, and it's still working pretty well. I'm not arguing any of the others one way or the other. I mean, they all have their benefits, but holding the physical gold, that's something they have a problem creating extra supply of, and that keeps them honest.
Well, John, I want to thank you so much for your time today. You already told my listeners how to sign up for your newsletter. I think you're offering some type of deal on what two year subscription at some type of a discount.
Well, yes. Again, contact me, John Williams at shadowstats.com, email by email, or just give me a call, 707-763-5786. I'm happy to discuss it with you. I have I put out a commentary that should be monthly. I've been sick this last couple of months, and it hasn't, it's staggered some, but it's back on full stream this month. And it is the it is the it's $175 for a year. Given the delays the last couple of months, I'm offering a special of 2 years for $175. You can also get it for 6 months, $89. And happy to set anyone up. You get the material delivered by a subscriber only email with links to the commentaries and to the data files. There is a website, www.shadowstats.com. Although the site was posted 15 years ago and did very well till the web host collapsed, and it's still there. It's got my archives going back for a couple of decades, but it was so difficult to get it to work or to restructure it that I just left that there as an archive. Again, you've got commentaries back for a number of years. You want to see what's been published, and what I'm doing now is I'm delivering the same material, the same commentary, same data, but I'm just sending it by email to subscribers with subscriber only links to the latest data and commentaries.